the big story of the day, the jobs number coming in just above expectations, at least on the headline print. 275,000 jobs added to the month. The Street had been looking for 200,000, showing some strength in the workforce. But we got to point out that unemployment rate did tick higher to 3.9%. The average hourly earnings on a month-over-month basis coming in just below what the Street was looking for, a 0.1% rise. Well, ahead of all this, earlier this week, Bank of America raising its year-end target for the S&P to 5,400 from 5,000. The bank seeing improved sentiment for the year and also expecting maybe some broadening action in terms of leadership. So let's talk about how this report fits into that call and what we could expect for equities going forward. We want to bring in Carey Hall, Bank of America's Securities senior U.S. equity strategist and head of U.S. small and mid-cap strategy. It's great to see you here. So first, just your reaction to the print that we're getting. I was just asking Josh, our markets reporter, whether or not this is exactly the type of report that the Street wants to see. What do you think?
Yeah, I mean, I think our economists were forecasting 215,000, so a little bit above consensus. Obviously came in stronger, but you did see a tick up in the unemployment, as you mentioned. So we are forecasting that the Fed will begin cutting rates in June of this year. So we're looking for 3 cuts this year, 4 cuts next year. So, we've still been in an environment where the consumer is strong. We expect inflation to begin to continue to cool. But we do see the case that the equity market is more likely to go higher than lower from here. So I think equity market sentiment has certainly gotten more positive, but euphoria is not really what we're seeing in the broader market yet. It's been more concentrated in pockets of the market, themes that we've seen like AI and Magnificent Seven. But when you look at the broader S&P 500, we do see the case that you could see a broadening out of leadership to the rest of the market outside of some of the largest stocks. We also think that small caps could outperform this year, and that's an area that typically does well after you've seen a very narrow market like we saw, over the past year.
Jill, it's clear that this is a Fed that doesn't want to be accused of being too quick to cut. And so with that in mind, higher for longer has been what they've put out there in terms of their commentary and their tenor thus far. So now if June is on the table, what does the rest of that pacing look like? And is there anything within that the market is already expecting, already pricing in at this point?
So we're looking for 3 cuts this year beginning in June, and then 4 next year. I think when you look at the market today, the market has been trading at rather elevated valuations on the majority of metrics we track. So if we look at 20 different valuation metrics for the S&P 500, the market looks expensive versus history on 19 out of the 20. And I think when you look at valuation, it does matter. It tends to be a better predictor of long-term returns than short-term returns. So we could definitely see lower than average equity market returns over the next decade if you have a long time horizon, still positive, but call it 3% annualized returns over the next decade, or what valuations are suggesting today. That said, we could see valuations get more expensive near term. Certainly that could happen. We tend to be in an environment where the market, we think we're in an environment where the market has gotten higher quality. It looks a bit different than it has been in prior decades. It's less levered, so there could be reasons that we see a lower equity risk premium than we've seen in prior decades, and better normalized earnings power for the market.
Jill, when it comes to the valuation concerns that we have started to hear more and more about, rightfully so in some cases, since the start of the year with the massive run-up in tech last year, obviously continuing that momentum this year, do you still see, I know you're expecting a broadening out of leadership, but do you still see technology, some of those larger cap tech names, being among the outperformers?
Well, I think if you continue to see, passive inflows into the market, this could certainly benefit some of the growth stocks. But if we're in an environment where profits growth is accelerating, and that's what we expect, that corporate profits growth bottomed last year and continues to improve, inflect positively, that's an environment where value stocks tend to lead. So, if overall growth is becoming more abundant within the market, then one doesn't need to pay up for expensive growth stocks. So we do see the case for value stocks, and I think investors have been very underpositioned in some of the themes, like cyclicals, like value, even high beta stocks. Investors have been very underweight relative to history. So we do see the case for leadership broadening out to some of these other parts of the market that haven't been very concentrated by investors recently.
Jill, you also like some of the small and mid caps, the SMID as well, to outperform large this year. It hasn't necessarily been the case so far early innings of the year. Where do you expect that kind of trade to take hold?
Sure. So the small caps did lag in January. Since early February, we have seen them start to outperform again. We do think that continues. When you look at small caps, they have typically outperformed when profits growth is accelerating, when you've had periods following a narrow market like we did. We've also seen small caps, some of the indicators that are most correlated with small cap outperformance, like the manufacturing ISM index inflecting. A lot of those indicators have been inflecting more positively. So, the small caps are also an area that are a lot cheaper on a valuation basis relative to large caps. The relative multiple of the Russell 2000 relative to the large cap index is still trading at, multi-decade lows. So that's an area where we see more valuation upside, and where we think you could see better returns this year. But we would still obviously focus on the higher quality small caps, stocks that have earnings rather than no earnings, stocks that have better, more predictable earnings.
Jill Carey Hall, who's the Bank of America Securities senior U.S. equity strategist and head of U.S. small and mid-cap strategy. Thanks so much for taking the time here. Appreciate it.
Thanks.